Shut up and let me enjoy this pain.
Welcome to the pain zone. It's where we live.
When I'm hurt, I love it. I love that feeling because it's real.
You need to love pain.
Be the guy who embraces the ugly, the miserable. Be the guy who embraces hard work, the grind. Don't be afraid of being hurt. Don't be afraid to sacrifice some blood.
Everything else, happiness could be fake, crying could be fake, but pain? Shit. That's real.
However, mentally, physically, love it. You need to love it. If not, stay where you are.
Pain is real, folks. That's what the Bitcoin Maxis are telling us. From have fun staying poor to pain's a good thing. It's real. The money you're losing in your crypto and all these meme coins, that's not real. But pain's a good thing. Pain's a good thing. What are we complaining about? We're losing money. Who cares? It's a good thing because it's real. Those feelings you get from losing money, that's the beauty in the pain. It's Eckhart Tolle 101. Bitcoin is down nearly 30% from its all-time highs about 6 weeks ago, from 124,000 down to 87,000 at the time of filming, down 20% this month, and $4,500 today. But if we go past Bitcoin, we can see why everybody's starting to freak out a little bit. This is the worst November start in the S&P 500 since 2008, the year of the Great Recession, which was historically one of the worst months. We have 4 straight down days this week, November 14th to 18th. And you can see why people are now starting to get a little bit nervous about what's happening here. Fear is here. The CNN Fear and Greed Index is at extreme levels of fear. Over 50% of investors recently polled are saying that they are bearish on the market for the next 6 months. And a lot of this is because most of the market gains have been tied to like 10 stocks, many of which are just investing in each other. Some are now taking on debt. Amazon just announced a $15 billion bond offering. And I think that they're all freaked out that if they don't go all in on AI and start spending money, well, they could get left behind. Damned if you do, damned if you don't. We don't know if right now is the time to be making those investments. But if AI takes off the way that it looks like it might, Joe Rogan had just had Elon Musk on, and he said in the future, we won't even have apps. It'll just be AI that does everything for us. And he wasn't talking 20 years from now. He was talking less than 5 years from now. So everybody's kind of freaking out a bit. Nvidia leads the charge. Google's now making their own chips. Amazon's about to start making their own chips. We're about to see chips get commoditized. Who knows what that means for the market darling Nvidia? Everybody's kind of freaked out about stepping on their toes because they still want access to those chips. And now we have the forward PE ratios of the S&P 500 trading over 30 times. That means it costs you $30 per dollar of income if you're investing in a stock. So if you're investing in a company that generates $1 million in earnings, the valuation is going to be $30 million, which is extremely, extremely high. Bubble territory, if you will. They say once we get north of 30, we're in the danger zone. Well, this is what's basically been the norm for us these last few years. One of the things that I think has a lot of people freaked out is that the Japanese 10-year just hit 1.835%. It's the highest level it's been at in 17 years. Last hit there June 2008, which has everybody freaked out about this thing called the carry trade, which is where investors borrow yen at nearly 0% rates, then they convert to US dollars, then they invest in assets, probably in the US, might be Nvidia, Google, Amazon, those darling tech stocks that seem to just go up in double-digit numbers every single year. And then the difference between what they're paying to borrow in Japan and what they're yielding from these big tech stocks, that spread is their profit. Now we're facing this unwind risk, whereas these yields rise, it means you got to pay a higher rate. You're not going to be able to convert your US dollars back into yen at the same rate. And suddenly we might start to see some forced selling. It has a lot of people freaked out that Japan could take down the entire stock market. Now, if you go to companiesmarketcap.com, Nvidia is the clear winner here at $4.4 trillion. Well, we got a couple things to note here about Nvidia and how this might take down the whole market. First off, we got Michael Burry. I know that he's sort of turned it into a bit of a running joke because he keeps acting like Chicken Little on Twitter, acting like everything's going to be a crash. But he did predict the housing bubble, and it's like it's his dream to find the next bubble. And he thinks that what's happening right now in AI is exactly that. He thinks it mirrors the .com and housing bubbles, that all these hyperscalers are inflating their profits by extending server depreciation schedules. In other words, that they're acting like these chips are going to have much longer lives than they will, that there's been billions of dollars in CapEx with no clear ROI, which is classic bubble accounting fraud, and that he's placed huge bets against companies like Nvidia and Palantir, warning sometimes the only winning move is not to play. Up next, we have Peter Thiel. Okay, Peter Thiel recently exited his Nvidia position, selling 5 million shares worth $1.8 billion at $120 to $130 average. 0 shares remain in the founders fund, and the exit came weeks before Nvidia's 20% drop. And he's saying it's part of his broader AI profit-taking strategy, which he's also dumped a whole bunch of Palantir. So does this mean that it's all over and that we should start to be like the Bitcoin maxis that say that pain is a good thing? Well, I look at the price of gold and it hasn't gone down that much, despite the fact that everybody around me is screaming about how awful things are. It's almost like gold's wealth preservation status is a real thing. There's another real thing, and that is when Ben Bernanke first said the words quantitative easing was the very moment that the US government signaled to investors that they will not allow too much pain to happen. What do I mean by that? What I mean is our entire world, our entire economy is now so securitized, so financialized, and so debt-driven that there is zero chance the US government is going to allow for a massive stock market crash. Sure, there could be moments of the world's going to end. The US economy as we know it is done. Everybody run for shelter and stock up on guns and canned tuna. We're going to have those moments. We could see the market drop 50% from here, at which point we're only at a 15 times multiple on the S&P. That actually sounds pretty reasonable to me. That sounds pretty reasonable. Could we see a 50% drop? Yeah. But then you got pension funds. We've got this massive private equity, private credit bubble that will take down those pension funds who have recklessly put money into all of these funds to deploy capital into stupid businesses where they can just exchange assets to each other and pretend that they are getting huge returns. People won't be able to pay their mortgages, their credit cards, their home equity lines of credit, their car leases or loans, their student loans. You see, deflation's a bad thing because if we get deflation, it means that we can't pay for all this debt that we've created in the system that is massively financialized. We've securitized everything. The US government knows this. The Federal Reserve knows this. And every central bank in the Western world knows this. I believe that what we're seeing is the early stages of the storm before the calm. And that is to say that we will inevitably see the government step in and print a whole bunch of money and make everything okay. Journal entries to the banks, go start lending to people, bail out these big AI firms, whatever they got to do, they'll do it. And gold, you ain't seen nothing yet. $4,000 gold, it should scare people. It should scare people because the regular conversation in households moving forward is going to be conversations about the value of money in real versus nominal terms. When we talk about how much stuff costed 3 years ago, as opposed to today, we're going to start using terms like real and nominal, meaning we're going to start to think about inflation and we're going to start to freak out about how if we have cash in our bank accounts, well, by golly, we better go and spend that because those dollars in our bank accounts are going to be worth a whole heck of a lot less money tomorrow than they're worth today. Negative real rates, that's the future, folks. We will have much higher inflation than what the rates are at the central banks. They'll probably fudge the data, but I wouldn't be surprised if we see those negative real rates even with the fudge data. It'll be much worse than what they tell us. I went to Subway the other day and I paid $18 for a turkey sandwich and a drink. That same combo would have probably cost me $11 just 5 years ago. But if I look at what food inflation is telling me, it's telling me that the food's only up 35% in Canada in food services. Now, of course, I just cherry picked an example, but anybody who's been to a grocery store lately knows exactly what I'm talking about. Things effectively cost twice as much as they did, say, 10 years ago. And it's going to get a whole lot worse. And as people realize this and realize that big tech has problems, they're all freaking out about AI. They're taking on debt and they're trying to just make the trade that they feel like they have to make to not look like fools, even if there's a chance that they will look like fools. Investors realize this. They're going to start to look to hard assets. So there's too much money in the system, and a lot of these tech valuations start to make legitimately no sense. They're going to start to look to hard assets. Of course, you could buy farmland, but a lot of people can't afford farmland. It's too expensive. Yeah, sure, there's ETFs where some of the founders and managers take a spread for allowing you the ability to participate in those. But nobody really trusts Wall Street or Bay Street. So what do people turn to? They'll turn to gold. They'll turn to silver. You ask me, we ain't seen nothing yet. We're about to see an absolute storm of quantitative easing in the next 12 months. Mark my words on that. Will they call it quantitative easing? I don't know. It's a term they made up hoping that people wouldn't pay attention to the fact that they were printing money. In Canada, we called it LSAP, large-scale asset purchases. When pressed about it, Tiff Macklin conceded, yeah, it's the same thing as quantitative easing. Well, why didn't you just call it that? Because central banks want to try to get cute and try to trick us about what they're doing. They're like sometimes creating debt facilities and swap lines. They'll use all kinds of terms to try to trick us and fool us into thinking that they aren't printing money when they are. In the end, people are going to turn to hard assets, maybe guns, maybe canned tuna, but until we get to the point where everyone realizes that governments can't run debts and deficits infinitely, well, at some point, it's all going to turn to gold. And when you look at the price of gold, trading at $4,000, holding up here as everything around us is crashing, well, that just tells us you ain't seen nothing yet. Just wait until you see these bailout packages that are going to come in the next 12 months. And don't be surprised if gold hits $10,000 before the end of 2026. All right, everybody. Thanks for watching. If you have any comments on my crazy ideas of how the world works, let me know in the comment section. I thank everybody for watching.